The normally raging housing boom has slowed down quite quickly, as homebound individuals looked for new homes during the pandemic. Helped by historically low mortgage rates, the US housing market saw a boom. Real estate brokers now claim homes are sitting longer and sellers are being forced to drop their prices. Previously, they'd reported buyer lineups outside open houses and bidding wars on the back deck. That has sellers wondering where they stand. Our poll reveals that doubt has crept into many buyers' thoughts as recession fears weigh on consumer outlooks, according to Danielle Hale, chief economist at Realtor.com. The property market threatens to dull any recovery, despite hints that inflation may decline further in the months ahead. An important indicator of inflation, the Consumer Price Index, increased 7.7% from a year ago in October 2022. That yearly figure was the lowest since January, and it was still extremely high by historical standards. The monthly increase was also less anticipated, which raises the possibility that persistently high inflation and the harm it's done to consumers' wallets may be subsiding. Higher mortgage rates, according to Fed Chair Jerome Powell, will gradually restore balance to the market, he said, adding that overheated US housing market required a reset after seeing home prices jump over 40% in little over 2 years. Hi, and welcome to Stealth Wealth. In today's video, we're going to discuss how the housing market changed thanks to Congress. Before continuing with this topic, please do me a favor by liking and subscribing to this channel and clicking the notification bell for more financial advice, tips, and tricks. The true cost of the housing market's transformation is a tremendous home price boom supported by federal housing and monetary policies, which is pushing lower-income Americans farther and further out of the housing market. The AEI made the first mention of the current single-family housing boom in 2013, which started in 2011. Since then, there's been an imbalance between supply and demand in the housing market. Nevertheless, the Fed continued low interest rates and many rounds of quantitative easing, persisting even after the housing market started to grow at 16% in July of 2021. Federal housing authorities also relaxed underwriting. Home price increases were 17% in May 2022, and they're just now anticipated to decline as the Fed changes its monetary policy. As a result, many low-income and minority Americans are finding homeownership to be more out of reach. Take into account that while incomes have climbed by 38% since 2012, the cost of a starter house has increased by around 160%. There's more competition for fewer and fewer affordable homes as a result of this uncontrollable price spiral. Entry-level buyers are progressively being forced out of the market because they can't afford to compete with more wealthy purchasers, who face the same competition but at higher price points. People downstream are being affected by knock-on consequences from this. Since they're unable to own a home, they continue to rent, which contributes to the national average rent increase of 16%. Many people who are unable to pay these rent increases will be forced into homelessness. Not only that, but according to a Gallup study conducted from June 1 to June 20, 2022, the Gallup Economic Confidence Index is currently at its lowest point since 2009. Being able to scrape by, much alone accumulate money to buy a home, is growing harder due to inflation, which is a regressive tax. Since minorities are significantly behind white Americans in home ownership and intergenerational wealth, erroneous policies have severely hampered lower-income Americans, particularly minorities. How can they ever catch up if they're no longer able to access the bottom rung of the housing ladder? The answers are easy to understand. First, avoid making the same mistakes twice. Congress has invested several trillions of dollars over the course of 70 years in program spending, tax breaks, and government-guaranteed financing. However, neither the objective of creating generational wealth for low-income homeowners nor the objective of making owner-occupied and rental properties affordable for low-income households have been achieved. Buying a home has undoubtedly presented difficulties for everyone during the past 24 months. Mortgage rates have increased significantly this year, but even throughout the second half of 2020 and 2021, when borrowing rates were much more competitive, there was a severe scarcity of property supply in the market. This year was no different in that regard. Additionally, housing costs tend to increase when buyers are competing fiercely for available properties. The property market is, however, a competitive one for more than just regular purchasers. Buyers need to also contend with investors, including large corporations that amass vast property portfolios as well as individual landlords who buy homes as rental properties. In a market where housing prices have risen over the previous couple of years, investment corporations have unquestionably had an edge over normal purchasers. Even when homes are highly expensive, they have the money to put down for them. On the other hand, everyday purchasers often need to stick to a budget to make sure they can afford their mortgage payments. However, some legislators are working to end the practice of investors purchasing real estate. And if they get their way, it may significantly expand the market for normal purchasers. The Stop Wall Street Landlords Act was a new measure that California Democrats filed in November. Its objective is to stop large investment companies from buying up houses for financial purposes while preventing normal buyers from doing so. If the measure is approved, it'll increase the cost of house purchases and sales for single-family rental corporations with assets of more than $100 million by adding new taxes to those transactions. There are several investment companies that now possess tens of thousands of homes all around the United States. When mortgage rates hit historic lows in 2020 and 2021, yet inventory also dried up, several of these companies were able to expand their holdings. Since mortgage rates dropped and demand rose, many average buyers have been unable to buy a home. Additionally, despite the fact that mortgage rates this year are far higher than they were in the later half of 2020 and 2021, a scarcity of inventory is still compelling purchasers to compete not just with one another, but also with investment organizations that have abundant financial resources. Next, the federal government has a checkered background when it comes to zoning. We are currently suffering as a result of the discriminatory zoning and land use rules that the federal government oversaw the implementation of in 1921. These laws were intended to keep newly constructed homes out of reach for certain racial and ethnic groups. It can't be disputed that we require greater market rate supply. Subsidies and cheap loans, however, are not the answers. There's a growing agreement that in order to lower home costs, we need to expand supply rather than loosen credit standards, boost government spending, or lower interest rates. We require additional market rate supply to halt the price spiral that's pricing out Americans with lower incomes from the housing market and raising rent. Additionally, zoning and land use regulations are primarily a state and local government concern and need to be handled there. Even in California, where the legislature just established regulations that might significantly boost new development activity, we're already seeing promise across the nation. Next, it has been established that government measures to increase demand are ineffective. The Fed has just recently come to the conclusion that it needs to shut off the money supply. However, its policies have already caused significant harm and will continue to plague lower-income Americans for years to come in the shape of rising property prices, inflation, and rent. Because of the cumulative effect of these changes, borrowers and neighborhoods will be less able to resist an economic stress event. Instead of reducing lending requirements, authorities should take further steps to safeguard borrowers and taxpayers from various economic threats that are present, including those posed by increasing interest rates, inflation, and sky-high property prices. We should prevent this from happening again since we've already watched this movie. What further steps should be taken in addition to those taken at the municipal and state levels to increase supply? For lower income and minority Americans, Congress should establish a legislative aim of systematically generating durable generational wealth. By cutting the loan duration on high-risk loans by 20 or 15 years, you may increase community and borrower resilience as well as intergenerational wealth. For low-income, first-time, first-generation house purchasers, the FHA or the Federal Housing Administration should develop low-income first-time home buyers or LIFT home. To lessen risk to taxpayers and encourage borrowers to accumulate equity, the GSEs or the government-sponsored enterprise ought to implement the wealth-building home loan. That's it for this video. Don't forget to like, subscribe, and hit the notification bell so you don't miss out on any of my upcoming videos. Please comment down below if you have any questions or suggestions. Thank you for watching, and until next time.